Most traders think profitable trading has to be complicated. More indicators, more confirmations, more rules. But what if I told you one of my cleanest 1 to 3 trades came from a strategy so simple that most traders would completely ignore it? In this chart, price left multiple clues before the move happened. The interesting part isn't the entry, it's why I refused to enter when everyone else would have. One small detail changed everything, and if you miss it, this trade never works. Let me show you exactly what happened. Before looking for any entry, I wanted to understand what the market was actually doing. Most traders immediately jump to the lower time frame, searching for setups, but that often causes them to miss the bigger picture. When I zoomed out, the chart was already showing a clear story. Price was approaching an area where I expected an important reaction, and that immediately caught my attention. At this point, I still had no interest in taking a trade. In fact, there was one question I needed the market to answer first. Was price preparing for a genuine continuation, or was it moving into a location where smart money could begin setting a trap? The next move would give me that answer. As price continued moving higher, something interesting started to happen. The market pushed above a previous high, which looked bullish on the surface and probably convinced many traders that price was ready to continue higher. But this is where things get deceptive. Instead of seeing strength, I saw liquidity being exposed. The market had just moved into an area filled with resting buy orders and breakout traders. The real question was this: was this genuine buying pressure? Or was price simply collecting liquidity before revealing its true intention? The next reaction would be extremely important. At this stage, most traders would already be searching for a sell entry. After all, liquidity had been taken, and price was reacting from an important area. But I was still waiting. The liquidity sweep alone was not enough to convince me. I needed proof that sellers were actually stepping into the market. And a few candles later, price delivered a clue that completely changed my attention. The moment I saw it, I stopped focusing on where price had been and started focusing on where it was likely going next. The clue I was waiting for led me directly to this supply zone. Now, most traders see a supply zone as an automatic sell area, but that is not how I use it. A supply zone only tells me where something might happen. It does not tell me what will happen. This zone became important because of where it formed and the liquidity that was sitting around it. The market had finally reached a location where a meaningful reaction was possible. But even here, I was not interested in entering a trade yet. I still needed the market to reveal its intentions before risking a single dollar. As price moved around the supply zone, another detail started to appear that most traders completely overlook. The market was not moving randomly. It was slowly building liquidity in a very specific area, creating the perfect reason for traders to become confident in the wrong direction. This is what makes inducement so dangerous. It gives traders a setup that looks obvious, but sometimes the most obvious move is exactly what the market wants people to believe. The important question now was simple. Was this liquidity being built for continuation, or was it fuel for a much larger move in the opposite direction? Price finally reached the supply zone, and this was the moment I'd been waiting for. Up until now, every clue suggested that sellers could become active here, but I still had no confirmation. Then the market delivered something much more important than a simple rejection. It delivered displacement. This strong bearish move told me that selling pressure was finally entering the market. For the first time, the balance between buyers and sellers was starting to shift. But here is what made this interesting. Even after seeing displacement, I still refused to enter the trade. Instead, I focused on what this move had just created, because that would become the key to finding a much cleaner entry. That displacement gave me exactly what I was looking for. Instead of chasing the move, I shifted my attention to the area where the displacement originated. This small zone may not look important at first glance, but it was the first place where sellers showed undeniable strength. The reason I marked this as my point of interest is simple. If institutions were truly behind this move, there was a good chance they would defend this area when price returned to it. So now the question was no longer whether sellers existed. The question was whether they would reveal themselves again when price came back to this zone. A short time later, price returned to the point of interest, and this was the moment that would decide whether the setup was valid or not. As price tapped into the zone, I noticed something very important. Despite the buying pressure, the candles kept leaving strong upper wicks behind. That told me higher prices were being rejected. Buyers were attempting to push through the area, but every attempt was being absorbed. At that moment, I finally had the confirmation I had been waiting for. Now the setup was beginning to make sense. With the confirmation finally in place, I had everything I needed to execute the trade. My entry came directly from the point of interest, while my stop loss remained protected above the rejection area. More importantly, the risk to reward made sense. I was risking 1 unit to target 3, which meant I did not need a perfect win rate. I simply needed the market to follow the story it had already been telling. What made this setup even more interesting was that these internal liquidity levels were not marked after the move happened. They were already on my chart before I entered the trade. This is an important difference because many traders draw levels after the market delivers and then convince themselves they saw it coming. I wanted to know where price was likely to react before the move started. As the trade developed, price began respecting those liquidity objectives one by one, which gave me more confidence that the market was following the exact path I had anticipated from the beginning. While most traders focus entirely on finding an entry, I believe the target is just as important. That is why I marked this sell-side liquidity long before price started moving toward it. The market had already shown displacement, the point of interest had been respected, and buyers were struggling to gain control. Now there was a clear pool of liquidity resting below price. The question was no longer where to enter. The question was whether the market would deliver into this objective as expected. Before ending this breakdown, I want to show you one mistake that holds back more traders than almost anything else. Most beginners spend all their time searching for the perfect strategy, the perfect indicator, or the perfect entry model. They believe profitability is hidden inside some secret technique that nobody else knows. But the reality is much simpler. The market rewards patience far more often than it rewards prediction. Beginners constantly feel the need to be involved. They want to catch every move, every breakout, and every opportunity they see on the chart. As a result, they enter too early, force trades that are not ready, and ignore the evidence right in front of them. The goal is not to trade more. The goal is to wait until the market gives you a reason to trade. In this example, I was not rewarded because I found a magical setup. I was rewarded because I waited for the market to reveal its intentions before committing any risk. That single habit can completely change the way you trade. So that was the complete breakdown of this simple trading strategy. We started with market context, identified the liquidity sweep, waited for price to reach supply, watched sellers reveal themselves through displacement, and then waited for confirmation before entering the trade. The interesting part is that nothing here was complicated. There were no indicators, no guessing, and no chasing the market. Just a clear story, a defined point of interest, and patience. If you found value in this breakdown and want to see more real trade analyses like this, make sure to subscribe, and I will see you in the next one.